Recently, an Israeli Air Force major was indicted for using classified briefings to bet on the timing of strikes against Iran. We're talking about over $500 million wagered on the timing of those strikes. Now, this is on the same platform that correctly called the 2024 election when pretty much every major poll got it wrong. So here's the situation we're in right now. Wall Street just put $1.6 billion into polymarket, and Goldman Sachs and JP Morgan are looking at getting in as well. But at the same time, Congress introduced the Death Bets Act to ban contracts on war and death.
Prohibit markets to allow people to bet on government action and on markets where there is one individual that controls the outcome of the bet.
And 37 states are suing over who gets to regulate these platforms. You're basically watching Wall Street bet on the industry while government fights over the rules. So, why are prediction markets such a big deal? Now look at what's actually happened over the last year. Monthly trading volume went from 100 million to over 20 billion. That's 240 times bigger. Kalshi went from 600,000 monthly users to 5.1 million. Intercontinental Exchange, the company that owns the New York Stock Exchange, put 1.6 billion into polymarket. Goldman Sachs CEO David Solomon told investors he personally spent a couple of hours with prediction market leaders and has a team evaluating opportunities. Paradigm is reportedly building a Bloomberg-style terminal specifically for prediction markets. Coinbase launched prediction markets for US users in January. In short, this isn't retail crypto gamblers anymore. This is Wall Street treating prediction markets like permanent infrastructure. And there is a reason that they're betting on this. The 2024 election basically proved the concept. Traditional polling had it as a coin flip, but polymarket had Trump at 58% and Trump won. And then there's Biden's withdrawal. Before the June debate, the odds sat at 20%. Days after that debate, the market jumped to 70%. Biden withdrew on July 21st, but the market had called it weeks before the media caught on. Now here is why this works. When you're a pollster, you get paid whether your poll is accurate or wrong. When you're betting real money, you lose that money if personal bias messes with your judgment. Being wrong literally costs you. Now, companies figured this out years ago. Google ran internal markets where employees bet on product launches. Ford's prediction markets had 25% lower error rates than expert forecasts. And HP's beat official forecasts 75% of the time. When people can bet anonymously, they tell the truth. And for everyday users, Google Finance now shows live polymarket and Kalshi odds right next to the stock prices. And Kalshi has signed deals with Fox News, CNN, and CNBC to display odds during news coverage. Now that is mainstream legitimacy. But if these markets were perfect, we wouldn't be having congressional investigations. There was a French trader called Theo who placed around $40 million in Trump bets across 11 accounts. That was roughly 25% of all the Trump contracts on the market. Now, as much as his money was still on the line, when one person controls a quarter of the market, you're not really seeing crowd wisdom. You're seeing what one really rich guy thinks. Now, Trump won, and Theo walked away with $85 million. Then you've got the problem where roughly a third of polymarket's volume appears to be fake. People buying and selling to themselves make the market look more active. If a third of the trading is fake, prices might not reflect real information. And researchers at University College Dublin found that regular people buying long shot contracts, anything under 10 cents, lose more than 60% of their money. They're not forecasting, they're buying lottery tickets. But none of that compares to early 2026. Like we said earlier, an Israeli Air Force Reserve major used classified military briefings to place bets on the Iran war. He made over $160,000. During investigation, one crew member said the entire squadron is on polymarket. The entire Air Force is betting. In January, somebody bet $32,000 on Maduro being captured, hours before the US launched military operations. They walked away with $400,000. Then, a month later, 4 suspicious accounts turned $40,000 into $872,000 betting right before the airstrikes on Iran. People with security clearances are treating classified information about military operations, about who's going to die and when, the same way insider traders treat stock tips. Now, some people argue that if your goal is accurate prices, you actually want insiders to trade, even if it discourages other people from betting, because that's what makes the prices more accurate. Now, the thing that makes prediction markets valuable, financially rewarding people for revealing private knowledge, is the same thing that makes regular people stop trusting them. You can't really have both perfect information and a market full of regular people who don't realize that they're betting against insiders. Now, Congress's response to all of this is a bill called the Death Bets Act, which would ban any of these markets from offering contracts on terrorism, assassination, war, or death. Now, the states have started their own fights too. Nevada got a restraining order against kalshi. 37 states have formed a coalition arguing that prediction markets should fall under state gambling laws and not federal commodity trading rules. Arizona went even further and filed 20 criminal counts against kalshi in March 2026. Now, the CFTC fired back on April 2nd by suing Arizona, Connecticut, and Illinois directly, trying to establish that this is federal jurisdiction. Now, here is where it can get interesting. Kalshi's own traders are currently pricing Democrats at over 80% to win the House in November 2026. Now, if that happens, the committee chairs who oversee the CFTC flip to the exact lawmakers who've already introduced all these bills. For all the forecasting wins and the Wall Street money pouring in,
you could do the same thing in a prediction market on a JP Morgan.
The reality is that these markets can still get skewed by whales taking outsized positions or by echo chambers of young, tech-heavy demographics doing most of the trading. The goal isn't to trust the market blindly. It's to recognize that a price tag is often more honest than a press release. And then there's the question of what these platforms actually are. Now, sports betting makes up 90% of Kalshi's activity and 40% of polymarkets, and they operate under federal commodity rules instead of the state gambling regulations sportsbooks deal with. So what are we really looking at here? Forecasting tools that happen to offer sports betting, or sportsbooks that found a better regulatory path? There's also a sustainability question underneath all of this. Oil futures work because producers need to lock in selling prices and airlines need to lock in buying prices. Both sides need the trade to run their business. Prediction markets don't have that kind of structural demand. Nobody has to bet on an election. When online poker lost its casual US players back in 2011, the ecosystem collapsed because only the pros were left. And the same thing could happen here once regular people realize they're often betting against insiders. So that is the real tension. The thing that makes these markets accurate, rewarding people for revealing private information, is also the thing that could end up hollowing them out. Do you actually use these platforms? And if you do, what are you betting on?